All right, welcome to the Investing Based on Fundamentals Guide to Fundamental Analysis. I'm Nimish,
And I'm Ankur Pathak.
and we're going to start with part two. Now, this is where the fun starts. This is going to be an exciting section on ratios and cash analysis, cash flow analysis. So, financial ratios. This financial ratios, there are so many financial ratios, by the way. So it could be used in combination. You are using several ratios to get the big picture of the health of the company and growth potential, profitability, valuation, and so on. So you don't use one ratio, but you use combination. In our case, in our analysis, we are using some subset of ratios. So what does the ratios do? Basically gives you a snapshot of financial health of a company, and which will help us make some informed decisions, right? It also does a benchmarking and trend analysis. The net profit of last year was higher than this year, then I'm doing something wrong here this year. It will give you some trend analysis. And then it will also tell you that you are spending too much money. You're spending too much money on wages. You're spending too much money on general expenses. You're spending too much money on facilities, right? Or you're doing pretty good on lowering expenses, right? In the internal management, the company CEO, CFO, they are also reading these ratios to improve themselves, to make some strategic decision making, right? So that's where ratios come. So let's look at the categories of those ratios. So what I've done is at a high level, we have four main categories of ratios. So profitability ratios are simply telling you, is company making profit and how is it doing in compared to other guys, right? So for you to know if companies are making money or not profit wise, you have to look at the profitability ratio. Then the valuation. Is the stock price too high? Is it overvalued or undervalued? So there are ratios that will help you find that out. Then liquidity ratios. Liquidity ratios basically tells you if something bad happens, can you meet the short-term financial obligation? Those loans that you need to pay on a monthly basis, can you pay those? How is your liquidity? How much liquid cash you have? Or can you sell an assets to pay off the current debt? So current debt is a short-term debt. And then solvency ratios is how is the stability of the company? Does it have enough money to stay stable? Can it pay long-term debts? And then in terms of assets, how many assets are funded by debt? How many things are on debt? Because that defines the stability of a company, right? So these four categories is what we're going to go through. So Anku, you want to talk about profitability ratios?
Yeah, so what specifically is a profitability ratio? Profitability ratios basically provide the insights into a company's ability to generate earnings through revenue, assets, and equity. And what we're going to discuss in profitability ratios are net profit margin and return on equity.
All right. So the earnings in relation to the revenue, assets, and equity. So how are my earnings compared to the revenues I'm getting, compared to the assets I have and the equity I have, right? So let's look at the net profit margin. This is one of the most important ratios. Uh, um, what top five? It will definitely come in top five. So let's look at this. If you're not talking, can you please mute, guys? All right. So you see your income statement. So in this case, this is a yearly income. This is for the year 2015, 16, 17. And I have the revenue, cost of revenue, expenses, and then the net income. First of all, you guys need to understand that the top line, this is how the word top line was framed, is the sales or the revenue. So top line is 229. And then the bottom line, the word bottom line came from income statement. Bottom line is 48,359. So what they do is they usually talk in an earning ratio, earning meeting call is, oh, the top line and bottom lines are good. or top is good or bottom is not good, or vice versa, right? So what here we are doing is net profit margin. How much did the a company make? What was that percentage margin, right? Compared to the total revenue. So the formula is nothing but 48 million is what proportion of 229 million sales. So in that year, they made this much, but this is the real profit. This is what the owners paid. After paying taxes and everything, this is what they got, they had in their accounts, right? And that comes out 21%. So 48 million is 21% of 220. Basically, the company made 21% profit in 2017. And so the next question is, how was it in previous years? So previous year is going up and down, but obviously they were making very good in 2015. In fact, they had, you can see here, 5 million more profit. It was 53 million, and they have 48 million right now, right? So this ratio is telling you that the company is doing actually pretty good. 21% is a good profit margin. Now, say you are comparing with Walmart and Kohl's, you're comparing with GM and Ford, then you will be comparing this way. You'll be looking at the profit margin over several years of Ford compared to several years of GM or Tesla. That's how you'll decide, oh, this company is profitable, or that one is not doing good for last 5 years, right? That's what this ratio is. All right, so that's that. The next one is the return on equity. And I won't go deep, but basically return on equity is how much is your net income compared to the total equity, $170 million or $170,000 compared to the equity of 930. So what is that percentage? So ABC, so see here I'm comparing two companies, ABC column, ABC company and XYZ company, XYX. So you can see here the ROE ratio of ABC is 18.2 and this one is 29.4. What it says is XYZ company has a higher returns on the equity. That means it's using more efficiently than ABC to generate profits. These guys are doing pretty good in terms of return compared to the equity.
So what are valuation ratios? Valuation ratios are financial ratios that are used to assess a company's stock valuation and determine if the stock is overvalued or if it's undervalued. So what we're going to discuss specifically in valuation ratios are earnings per share, price to earnings ratio, and price to sales ratio.
And these three are always, the first one is always discussed in quarterly earnings call. They will always talk about EPS. They'll say they estimate that the company should have this much EPS, and then the report comes out and they'll say actual EPS was this much. So they compare. The analysts were expecting $3 per share, but in reality, the company came out with the numbers and it was $2 per share. So it's not good. So the stock crashes right away. Right? So valuation is nothing but telling you whether the stock price is overvalued or not. It's one of the several ratios. So EPS, earnings per share, right? So we're looking at the income statement. And if you see on the top, I have 25 million. So this company has 25 million shares out there, total 25 million shares. The profit is $48 million. So if you divide profit 48 million by 25 million, your profit is $1.93 per share, right? So let's look at EPS for all 3 years. So you can see here in 2015, the EPS was good. So investors loved it in 2015. Then it went down for some reason, and then it slightly came up. So if there were two companies side by side, you would simply look at the EPS. But there are other ratios, other factors also. It's not just EPS. You look at the PE, you look at the PS, and so on. So PE, which is price to earning ratio, this is the most popular ratio. This will be the first one. The second ratio would be the net margin, net profit margin. The price to earnings ratio is nothing but how much is your stock price How big is your stock price compared to the earnings? Right. So example here is this company stock price was $19 in 2017. So what it's saying is the price of the stock is 9.8 times greater than the actual earnings. It is 10 times bigger than roughly 10 times bigger than the earnings. So now the next question that you guys should be asking is, it was much high in 2015. It was almost 48 times higher than the profits they were making. So this was overvalued. In 2015, the stock was overvalued. It was 102. The stock price was $102. And the PE ratio was much higher. And so this was bloated. Then it came down to 48 and now it's 19. And so this will help you decide whether to buy this stock or not. Because right now, this is probably fair valued or undervalued. But definitely, if I had to compare from this three, 2015 was overpriced. The stock was extremely expensive. And
Manishbhai?
yes.
Hey, sorry, I just cut out, my headset just cut out about a minute ago. Can I just ask a quick question because I missed it? When you say the 9.8, the 9.8 or 26.7, what are the two numbers they're looking at? That's the part I missed.
Yeah, this is the price to earning ratio. So 9.8, so in 2007, the stock price is $19. So what 9.8 is telling you is, looking at the income of this company, the price of the stock is 9.8 times higher than the earnings per share. Basically, the dollars they are making per share compared to the price of the stock.
Okay, and the earnings in this case is the 48 billion?
Earnings, this is the net income is the earnings, plus you have to convert at the stock level. So this price is at the stock level. This is total earnings, right? So total basically you divide the market cap, right? Total stocks multiplied by this multiplied by this divided by this. Basically earnings per share. We need earnings per share compared to the stock price.
Right.
Price per share. Right. So the earnings per share is, our stock price is almost 10 times expensive than what they are earning per share. But it was much worse in 2015. It was 48 times expensive. So this was overpriced 2015, and this could be normal. So if you look at Apple and all those good companies, Google and all those, they are in between 20s. Now, it also varies from industry to industry. Some industry will have a range of P's. Anything above that is overvalued. So Apple is 25, and I think it's but there are some companies like, I think Zscaler, or if you look at Palo Alto, it can go as high as 500. So it's super bloated. Netflix used to be 500 plus, because someone is thinking this stock is going to skyrocket in 2 years, and in 5 years it's going to be worth this much. So they all go and buy that stock like anything, and it bumps up the price, and it could be 500 PE. So that's very normal. That's highly speculative stock. So price to earnings basically tell you if the stock is overvalued or undervalued. And then price to sales. So some companies, they don't have earnings. They're growth companies. They don't have profits yet. So in that case, they usually look at price to sales. So the income statement I have here, has the company is making profit, $48 million, 2017. But PS ratio basically tells you what is the price of a stock compared to the sales they are doing, right? So compared to the sales, what is the market cap divided by sales revenue? So basically here in 2017, the price of the stock is twice the sales per share. So again, this is kind of aligning with PE ratio. The trend is same. So when the company is not earning, when this number is zero or negative, usually people use PS ratio because the sales data will be always there and market share, market cap number will be always there. Right. So you will get overwhelmed, you will get confused. You don't need to remember these formulas. You don't even have to look at the income statement because all this Yahoo Finance and all that, they will have the numbers right there on the screen. All right. So I'll quickly go through this. Go ahead.
So what is a liquidity ratio? Liquidity ratios indicate a company's ability to convert its assets into cash to pay off current debts. It measures a company's ability to meet short-term financial obligations and basically manage its current liabilities. So what we're going to discuss in liquidity ratios are just the current ratio.
So the current ratio is very popular. Current ratio is nothing but assets divided by liabilities. So basically it's checking, do you have more assets or more liabilities? Right. So here in case of ABC company, they have the current ratio is 2.32. That means they have 2.32 times liabilities. So they are safe. They have enough assets. And then the XYZ has the ratio is 1.46. So what they are saying is if something bad happens, if they have to sell the whole everything, if they needed to pay off the liabilities fully, ABC can sell $1 million of assets, pay off 430K, and would still have some money. So they have more safer. They have enough money to sustain and pay to the investors, right? So what the investors are concerned is they will lose the money if the company goes bankrupt. How is the liquidity situation of this company? That's what the current ratio said. So ABC is stable. It has enough buffer. So next one is solvency ratios.
So what are solvency ratios? Solvency ratios indicate a company's ability to pay off its debts and maintain its financial stability in the long term. And what we're going to discuss in solvency ratios are debt to assets ratio and cash flow to debt ratio.
So someone will say, how is this different than liquidity, right? Solvency is basically what is the probability? It will answer what is the probability that the company may go bankrupt or insolvent, right? So can they pay off long-term debt? And can they be a stable company, right? So investors want to buy a stock of a company that they want that company to exist for 10 years if the guy is planning to keep it for 10 years. So these ratios will help. So debt to assets ratio is basically what is the company's debt. So if you see company's debt is the short-term debt and long-term debt. So how much is that debt total as compared to the assets they have, right? So in this case, the ABC has less debt proportion compared to asset. Again, you don't need to remember, you will get overwhelmed, but these are the ratios there. This is another cash flow, how much emergency cash you have that you can use to pay the debt. This talks about so you have debt is 700K for ABC and you have 200K of cash with you, operating cash. So how much is the proportion wise that? Which one is better, right? That's what it's saying. So in this case, ABC has a higher cash flow to debt ratio, indicating it has strong ability to generate cash to pay off its debt obligations. All right, so let's summarize. Profitability ratios, the ratios that help to find out is the company making profit or not. Those are net profit margin, return on equity, and there are many more, okay? These are the best and the most popular ones that I've chosen. Valuation ratios, how's the stock price? Up, is too overvalued, undervalued? We have three ratios here. EPS, PE, PS, very popular. Liquidity ratios are basically focusing on the short-term debt, current ratio, assets divided by liability. Solvency is long-term, okay, will companies stay afloat long-term? For that, we have these two ratios. So, I mean, this is from a learning point. You don't have to do the math. All this data is already available on the website, but it's good to know fundamentals, right? So now what I'll do is I'll show you those statements and those ratios. All right, I'm so glad I see 17 people came. I'm telling you, this is good. If you're an investor, you should know this. All right, let me show you where are those ratios. And most of the sites will have this. So you don't need to worry. I'm a Yahoo Finance guy. So let's pick to Apple. So I'm in the main screen of Apple at the summary tab. See, here's the PE ratio, 28.81. And EPS is there, $5.89 per share is their earning. Their earning is the net income. And the company is making almost $5.89 per share. And these guys have millions and millions of shares. So let's remember, PE ratio is 28.81. Let's compare with Amazon. Or I could even try Samsung. Let's do Amazon, 28.81. Okay, they don't have the data. Let's try Tesla. Tesla will be much higher, 47.22. So this is overpriced, but the investors are thinking this has a very high promise potential, right? So the next question is, where are the other ratios? So let's look at that. Statistics. You see price to sales is here. Can you read it? Oh, where did that start? Price to sales ratio, there's price to book, but there are so many, but price to sales is there. Trailing PE means last 12 months of PE. Forward is they're forecasting what could happen in next 12 months. That's a forecast, right? And then look at the profitability. So this is Amazon, 13.66. You spend $100, $13 is going to Mr. Bezos. And then all these other details, there's a debt also. You'll get to see Amazon has this much debt. Where are the statements, the income statements and all that? These are under financials. This is an income statement, trailing 12 months, last 12 months. This is released as of last December, so quarterly. Well, in this case, sorry, yearly. Quarterly is, I can go quarterly also. So this is quarterly. So 31st of March 31st, this was released. So in that quarter, in the first quarter, they made $23 million or 23 billion, maybe, I don't know, of sales. And if you see the total income or net income for continuing operations is this much. So from this, they calculate the profit margin, right? So that's income statement. This is balance sheets. Total debt is this much. For that, this is for year, and if I do quarter, then this will be for quarter. They are desperately trying to sell. Cash flow, free cash flow, and there's an operating cash flow, which is also important. Now, see, these statements are very complicated. This is operating cash flow, 14 billion or $1 million. So you need to look at this, and usually we check all these things when we compare, Tesla versus GM versus Ford. That's what we do. Another website is
Nimit, can we do side-by-side comparison?
Usually if you buy those accounts, they allow that. You to pay money for all those things. They won't even let you go to 2015, 10 years back. You have to buy the thing. So Yahoo Finance plus Essential will help you. So why is this coming? So yeah, you can. If you throw in money, there are fantastic tools. These guys are excellent tools. See, another one is, I'll show you, MarketWatch is good too. So MarketWatch, let's search for Tesla. And so this is Tesla. I go into charts and I'll say, this will be interesting. I'll say, show me for all years. And now why did you put PE ratio chart at the bottom? So this is Tesla for last, let's say last 10 years. So the top chart is the price and the bottom is the PE. And see, if you see here, if you can read, its PE is 41. And then it became 1836 PE. 1,800, the price was super high. And then it came down because Tesla lost, the stock went down almost 50%. Now, right now it's 45 PE ratio. So this is, MarketWatch is also good. And if I go back and let's say financials, the same data that we saw in Yahoo, this is more organized. Profile. See all the ratios, valuation ratios, PE current 44. Net margin, this is the net income margin, 15 point. This is the final money they get. This is what the company made. In, is it from what period? This is for the year, fiscal year end 20. If you look at that from, oh, there you go. I don't know. You have to read the time span, but basically that's the profit margin. There's a return on assets, equity, current ratio, assets divided by liability. So their liabilities are smaller than assets, or assets are 1.5 times liabilities. So this Musk is not that bad. All right, so that's ratios, and there are so many sites. I'll show you another one. TipsRank is awesome too. I like TipsRank. So let's say Chipotle, CMG, we saw yesterday. Chipotle, and let's look at the financial.
Definitely. Are now unique actually.
Can you mute? All right, so income statement, these guys have summarized income, how is balance sheet, total debt 3.7 billion. This is the month of March this year. This is the latest released. How much liabilities they have. How much is the free operating cash flow? This is that emergency money. Emergency funds is 455 million. In case something happens, they have that cash. Right? So this is the EBITDA. Total revenue is this much. And let's see the charts. The charts are awesome. I think I saw a very nice chart yesterday where it had the net profit margin, stock analysis, ratios, earnings. There you go. Look at this chart. This is EPS, estimated EPS versus reported. So if you see this, this is quarter by quarter, looks like. So the blue bar, they missed here. Well, no, the light blue bar is the actual. And if you see a light blue bar is higher, taller than solid green or blue bar. Except for this guy. Quarter four, they didn't do good. But light is always higher. That means they're beating the expectations. And that's what here, the greens are, they beat the expectations. Red is a miss. Right. So you do all this type of analysis. If you are really confused between 2-3 stocks, this is what you do. You know,